I just want to kind of take us here, magically whisk us away to 2896 Dignan Street. I don't know why Dignan sounds like the name of like an athlete that the coach is yelling for, like messing around in practice, like Dignan. All right, 2896 Dignan Street, Jacksonville, Florida, 32254. It is a purchase price of $195. That's lower than we've had.
What do you know
lately.
about that, huh?
All right, a little preview.
Brought off the back shelves.
For a 4-bedroom, 2-bathroom home, which is bigger than usual as well, leased at $1,343 and a very attractive total ROI of 11.38%. GC, before we answer Jerry Ortega's question, what do you love about this property?
I thought you would never ask.
You tend to think that.
I'll tell you why I love this property, right? First, we're going to look at return on investment. Listen, 11% estimated returns. That's 11% on your money every single year is what this property should earn from all 5 profit centers. Very hard to find investments right now that are preserving capital, let alone earning a return on investment. So that's the first thing to take a look at. Look at what this rental property can do. Compare it not only to other rental properties, compare it to where else you have your money invested. Hard for you to look, especially over the next year, 2 years, 3 years, 5 years, and say, yeah, I'm probably going to get 11% on my money elsewhere. So that's the first place to look. But I'm going to go and tell you to look at another place that I usually tell you is not nearly as important.
Oh,
yeah. And it's not nearly as important, but I know it's going to perk up your ears right now. We're going to talk about price. Okay. Price is important. Of course, we need to fit it into your budget, but you first need to be a financial engineer and find the return on investment. But let's talk about price here. This one's under 200,000. I actually went back and looked at all of the properties of the week that we had done. The last 15 properties of the week, only 2 of them have had purchase prices under 200,000. That's 15 weeks now too. Yep. Right? Home prices continue to go up in Jacksonville and in many places in the country. So what that's talking about is really rare to be able to buy a property that is under $200,000. Like the last property you bought, what was that?
225.
225.
Yep.
Very rare for you to be able to buy a property under 200,000. So, for many of you who are thinking about getting into this asset class, a very common question is, how am I able to do this? I only have this much in my budget. How do I do this so that I can buy this property? Well, the easiest thing to do is to look for a low price property. This is a low price property, 4 beds, 2 baths, priced under 200,000, very rare. So this is one that might be the right one for many of you, especially if you're on a budget.
There you go. That's a lot to love, or a little to love, however you want to put it. Huh?
A lot for a little.
Chris Gonzaga is saying supply has a long way to go. And speaking of these like moments in time, we got more breaking news about mortgage rates.
Double breaking news.
Double.
Man, there's so much breaking news going on.
Right?
So let's talk about interest rates. Okay. So if anybody has been paying attention, especially over the last couple of weeks, mortgage rates have actually dropped. Nationally, they have dropped about 0.5% for the last 2 weeks. I actually did some research on this. They dropped for the second week in a row. This is actually the largest decline in interest rates over a 2-week period since 2008. So a long time there. So this is pretty significant. I thought we should talk about why this is happening and how you can take advantage of this as an investor here. Now, to put it in perspective here, interest rates are still about 2.5% higher today than they were 1 year ago. So, they dropped 0.5%, but it's nowhere near where it was before. But why is this happening? Well, a week, 2 weeks ago, yesterday, as this inflation news continues to come out, investors have basically kind of like resigned themselves to the fact that a recession is happening, right? A recession is happening. In a recession or going into a recession, investors go into preservation of capital mode. And when you talk about stocks and bonds, what that means is they take their money out of equities or stocks and they put them into bonds because they have a fear of recession. Recessions generally do not treat the stock market well. And so they're going into asset protection. They're going into capital preservation mode. And so investors are dumping money into bonds because of the fear of recession. Many people aren't aware of how long-term interest rates work, right? And what are they tied to? Well, when the Fed says they're raising interest rates 0.75 points or a point, that's them raising the short-term interest rate. It has an indirect effect on long-term interest rates. But if you want to see what long-term interest rates really kind of how they're acting based on the market, look to the 10-year Treasury yield. That is an investment that investors look at and say it's very similar to the type of risk and return that I would want to get. And if you look at the 10-year Treasury, if the 10-year Treasury is going up, then mortgage interest rates tend to go up. If 10-year Treasuries go down, then mortgage interest rates go down as well. And so over the last couple of weeks, people have been dumping money into 10-year Treasuries because they're fearful of a recession. And so what that does, when you dump money into the 10-year Treasuries, that actually brings the yield down on 10-year Treasuries. And so that's what has actually brought down the long-term interest rates as well. And why is this happening? It's because there's this movement now that they were holding out hope that we weren't going to get into recession. And these inflation numbers, 8.6% last month, 9.1% yesterday, people are finally like, listen, there's no way the Fed can pull us in as a soft landing. There's no way that we can get inflation in check and not bring us into a recession. Whether you believe that or not, that's what's happening when it comes to mortgage interest rates. So the thing here is, how can you take advantage of this, right? Because I think this is an interesting time right now. We're getting a little bit of relief on interest rates. And it might be this temporary, and what I believe is this temporary relief that probably is not going to be here for a long time, because on the back end, on the other side here, we just talked about how the Fed is going to be raising interest rates either 3/4 of a point or a point. And they're going to keep doing this. They're going to keep pounding these interest rate hikes until they get inflation under control. And we have no clue when the war in Ukraine is going to end. We don't know when China's zero COVID policy is not going to negatively affect supply. So we would expect short-term interest rates to keep rising from the Fed, which will have an indirect effect on long-term interest rates. So right now, I really believe this is probably a moment in time where you get a little bit of interest rate relief. Yeah. You can put you can put this home under contract here on Dignan. You can lock in your interest rate as soon as you put it under contract. You can get these interest rates right now, which are getting temporary relief, and you lock that temporary relief interest rate in for 30 years. And it's very likely that interest rates in 3 months or 6 months from now are going to be higher than what you have the option of doing today. So I think this is really timely, and it's a great time to buy a rental property, not just because of that, but again, think beyond where you're putting your money elsewhere. Hold the money that you have elsewhere accountable to the same way that you're holding this rental property accountable at 11% returns. And I think you'll see why owning this rental property right now using smart debt is a great option for you.
I mean, it seems like a heck of a deal, man. Like we've known, one of the reasons that I cashed out an IRA and bought a rental property is because I know that mortgage rates are going up. I know that prices are going up, and I know that stocks are going down, right? So, I took that action based on that. The idea that there's this tiny little blip, I mean, there's no way to time it, right? Like unless if I was sitting in the sideline right now, I'd be like, oh, amazing.
Right.
Because whatever this short-term blip would be like, that $220,000 house that I bought, I'd buy this $195,000 house. But it seems to me like this is a similar kind of like even smaller window than before. 2 years ago, when you started, Rich Richie came on and goes, moment in time, generational wealth right now. And everybody started buying rental properties, and that convinced me as well and all these other folks. This seems like another like micro moment in time where there's like a tiny dip down ahead of like a big rise up on interest rates, and prices are going to continue to keep going up. So it seems like a time for a good deal.
I think it is. I wasn't even expecting this one too.
Yeah.
It's just kind of happened, but I think it bears noting.
And that 10-year bond thing, that's interesting, man. So is that just like a reactionary thing that happens automatically? Like, is that a robot that is saying when this happens? Or is that like people looking at it and being like, well, this went down, so we're gonna bring it down.
It's just like risk and return. It's the market speaking. So investors who could put their money into mortgage-backed securities say, well, I should earn like interest rates right now are about 4.5%, or I could earn about maybe 3% in a 10-year Treasury. And for them, that risk return is worth it. And it's just kind of pegged. They're like, well, I should get this return for taking on the risk of a mortgage-backed security. It should be more than a 10-year Treasury because it's not backed by the full faith and credit of the U.S. government. But just historically, it's really measured and tracked itself. So it's not a robot, it's the market speaking, but historically it has kind of been a peg for each of those sentiments.